so here's something I'm working on. I looked at let's see, today is Saturday. On Thursday, I looked at stock items that had a high volatility but were headed in the downward direction. And what I came across is this, BCTX. Now, this company, I'm not sure why the IV was high on it for the actual shares, but I did notice that it had a high option market price for things that were within close to the current strike range of what it was when I bought it. So if you look, let's see, I bought 200 shares at a cost of $9.05 per share. And the reason why I bought 200 shares was so I could turn around and sell 2 option contracts at the $10 strike price in about 40 something days out. And the price for those, the price for selling the 2 contracts was about $392 total. And since selling the 2 contracts at the $10 strike, the price of the stock went down to $7.90, which means right now, even though my loss on the stock of holding the long shares is $229, I've made a profit so far of $132, so, or 33%. And the plan is, if it keeps going down further, once I get to about maybe 50-60% gains on this, I would go ahead and buy to close the current call contract that I had sold to someone and made a profit on. I would buy it back and then open up a new contract. Let's see, 124 days out at the $10 strike, and collect another $220, or by the time the market opened Monday, maybe like another $200. So that way, as the price continues to go down and theta is eating away at the option contract, I can continue to collect money from allowing people to have an option contract to buy these shares from me. Eventually, if it does go above the $10 strike and I get assigned, not only will I have made the money that you saw on the previous one for selling the contract that has now gone down in price, but I will also get the almost $200 for the first one, and then there's another $200 that I'll get here, so $400 plus whatever the gain was from the $9 to the $10 strike will all be profit. So that's a pretty good deal in my book, and I hope this helps somebody. All right. Okay, real quick, I forgot to add this part in, so this is like, I guess, a 2-part video. Fidelity has this tool called probability calculator, right? So if we go to the probability calculator, you can get a probability based off the 90-day volatility. We can up that even to 180 days of the probability of the stock reaching a certain strike price. So if I go and I sell, when I buy back the call option and I go sell another one that doesn't expire until January, right, and then set the strike price, come on, okay, let's do it up here. Strike price of, hey, is it gonna be what's the probability of it making it to $10? And as you can see right here, this tool is saying that on this date, based off of the historical movements of the stock, it has a 16% chance of being above $10, which pretty much tells me that it's not going to reach the $10 mark. And if that's the case, I'll walk away with another $200. And then I just keep doing that. So keep buying back my contract around here, and then sell another one that doesn't expire for a few more months. And essentially I'm making money on holding on to the shares. And eventually when it does go back up to $10 a share, like, see, so if we say $10, let's do this. $10 a share, put the target date, cut more months out. What's that look like? Wow, still has a low probability of being above 10 bucks. It looks like it doesn't have a good chance of being above 10 bucks until, wow, almost sometime out in June, July. So I can keep doing this over and over again, and I'll keep collecting cash. But that's a neat little tool, the probability calculator, so you can see which stocks are good ones to buy, hold on to, and sell option contracts against because the volatility is kind of high. All right,